Hey Harvesters, and welcome to Project Premium Harvest. My name is Matt. In today's video, we're going to be going over the premium I made for April 16th, running covered calls against the S&P 500. We're going to talk about the premium. We're going to be talking about the analytics that were looked at before making and choosing a strike price for my covered call options. And then number 3, I'm actually going to teach you guys how to run a covered call, and then we're going to discuss what I plan on doing for tomorrow, April 17th. So let's get kicking. You guys know me. The first thing I like to do is talk about my account value. Currently, the account value is at $85,807.07. Now let's go to the spreadsheet and talk numbers, and then we'll go back to the Robinhood, and then I'll do a demonstration of how to run a covered call. All right, guys, kicking it off for April 16th, I bagged $148 of premium, running 2 covered calls against my 200 shares of SPY. And to understand how I made decision point for choosing a specific strike price for these contracts, you have to understand what price did I buy my shares of SPY. The first 100 shares of SPY I bought in at an average of $527.82 a share. So we can round it up and say $528. And then for the second set of 100 shares I bought a few days ago, the average share price for the SPY shares were $540.29. So we want to round that up. It will be $541. Keep the numbers very simple. So now let's dive into it. When the market opened today, it was trading roughly at the $533.01 range. And so the first contract I bought with my shares that were averaged at 528 is I chose a strike price that was $5 away from the 533. So then I chose a 538 strike price, and that netted me $99 for that one contract. The second contract that I sold today, I chose the 541 strike price because even though I didn't think the market was going to go up, I still didn't want to potentially risk selling my shares at a loss. So I chose a strike price of 541 because that matches closely to the share price of my second set of 100 shares that I bought. And at the time, the SPY was $532.75. And then I bagged a $49 premium for choosing a strike price that was a little further away. And so that's kind of what I was saying in my other videos with regard to the lever. If you want more premium, then you have to choose something that's closer to the money, but then you're not going to get as much appreciation in the actual share price of the fund. And the opposite, if you want more appreciation, you're going to get less premium. So then there's kind of that lever of like, do you want the premium or do you want the appreciation of your funds? So for me, I am trying to not sell out of these 100 shares as much as I can. And I just want to continue racking a premium. And I want to find that fine balance between share price appreciation, premium, not getting my shares assigned. So that's kind of like the balance and the calculation I'm going through. But if we look at, since I started running my own covered calls against 200 shares of SPY, I have netted $2,424.03. Guys, this isn't even using most of the margin or the amount of margin I was using investing into high income funds. I still have another $180,000 of buying power available to potentially throw into SPY. But as I was talking about in my previous videos, I think the market is going to kind of trend slowly downward unless there's some very positive news talking about tariffs and like the whole economic order. So therefore, in the meantime, I think the share price for SPY and just the market in general are going to trend downwards. So I'm going to be trying to buy in at maybe below $500 a share for SPY. That's kind of where I'm targeting. I already have a buy set for, I think, the 494, waiting for the share prices to go down that low so I can scoop up another 100 shares and then continue running the strategy. And then I'm also holding another 100 shares of buying power available for after this 90-day pause in tariffs, because I'm not trying to be political. I'm just trying to talk about the arbitrary facts. There is a lot of uncertainty in the market, and with uncertainty, the market's going to fluctuate and it could potentially go down. So to protect myself, I'm trying to be smart and I'm trying to think ahead of the problem. So we understand that there's a 90-day pause. So we have to start planning for what that 90 days is going to look like. Is there going to be a potential buying opportunity? Is there going to be a dip in the market? Is it going to go up? So there's things we have to start thinking about because those are factors in us making money. So we have to be aware of them. Regardless of your political stance, if you're for or against it, it doesn't necessarily matter. You still have to figure out how could you make money in this specific circumstance. With that being said, now let's go back to Robinhood. I'm going to show you what I plan on doing for tomorrow. I'll execute a contract. It's not actually going to hit because usually at the nighttime, the premiums are way higher than they are in the morning. In the morning, they cut in half or cut to like 1/4 of what was on the previous night. But I'm just going to execute one, show you guys what it looks like. And then, yeah, and then hopefully you can incorporate this to your portfolio, and we all could be making tons of premium together and start racking in that harvest, baby. Let's go. All right, moving over to Robinhood. All right, back to beautiful Robinhood. We're going to click on the SPY and go over to this beautiful section that says trade SPY options. It's a free money printer. All you got to do is click it and then you start making money. It's crazy how it works. All right. So what we're trying to do here is, you see at the top of my screen, you have this buy and this sell and the call and the put. So basically what I am doing is I own 100 shares of a specific underlying. You can do this with SPY. You can do this for Amazon. You can do this for whatever fund you want, nvdy, any company you want to invest in. But what we're trying to do is we're trying to sell calls. So 100 shares is one contract. This sell button means that you're going to be making premium. This buy button means you're going to be paying money to lock in a specific share price for the underlying you're wanting to invest in. Sell call, the market is currently trading after hours at 529.83. So if you remember what I was talking about, we have to think about the considerations. I have 100 shares of SPY that I bought at 527. So I can pick something at the money and then make a decent amount of premium. However, I do want to choose something that's maybe $5 away from this price. So I'll be looking for maybe this 535 for about $129 of premium for this one contract. So I'll probably pick this guy, and then it's going to give you a couple of different options. This chance of profit indicator, don't even look at. Percent change, I don't really care about. Break even, nothing. The only thing I really care about when I'm doing my own research is the actual premium. The strike price is to make sure that it's not below my cost basis. And then, yeah. So now let's go to continue. So we have these covered call, total credit. So credit means you are going to be paid $1.29 for every one share. So you're going to make $129, and you're seeing this as credit. So it's going to give you some more details in the top right-hand corner. Maybe I'll scroll in a little bit so we can enhance our vision a little bit more. Okay. So we're going to buy one contract. I have 2 contracts, but just for this specific example, we're going to talk about the shares I bought at the 527 price. So one contract. So this bid price and this ask price, I'll usually just ask whatever they're bidding. For me, making an extra $10 or $5 per contract, I don't necessarily care, as long as I'm continuing to consistently make premium every single day. And we'll do good until cancel, estimated credit, because there's like a little bit of a fee, 4-cent fee. Review the order. You're agreeing to sell 100 shares of SPY at the 535 strike price before April 17th. And cool. Done. So the order is in. What's going to happen when the morning comes about is that contract, that order I put in, whenever it hits that specific bid price, it's going to automatically sell my covered calls when an investor invests into it to that investor. So that investor is paying me $129 to reserve the right to buy my shares at 535 if it hits that 535 strike price. If the strike price is not achieved, like the market stays at this 530 and completely stagnant, I keep that $129 premium. I get to keep my shares. I get to rinse and repeat, and I get to keep this going. But if for whatever reason the market shoots up from this $530 to 535 at the end of the trading day, if it's 535, then those shares are going to be assigned from me. So they're going to be taken away and be given to that investor that paid that $129 premium to reserve the right to buy my shares. So the way that works is I'll make that $129 of premium, but I'll also make that $500 of appreciation from this 530 to that 535. So there's the one benefit. But since I bought the shares at the 527, I'd make $800 of extra appreciation of me selling out of that 100 shares of SPY. So that's how that works. Now for my second set of SPY, I bought them at the 540 price. So now let's look at what the premium looks like for the 540, maybe the 541. So to be safe, I like to choose a strike price that is above my cost basis. So this 541 is going to be perfect. But you guys can see here, the higher you go away from the at the money, the lower the premium is going to be. So that's kind of what I was talking about, the lever. If you want more appreciation, this is quote unquote appreciation from the current trading price. You're going to get a lot less premium. But if you go the other way, you want more premium, then you're going to get less appreciation in your share. So it's just that lever that goes back and forth, and you're just trying to find that right touch point. For me, what's consistently worked is choosing a strike price between $5 to $10. When the market opens and it's kind of showing green, I usually wait about 15 to 30 minutes before I actually execute any of my covered calls in the morning, because the beginning of the morning should just shoot straight up or you can shoot straight down. So I kind of wanted to kind of, mellow out a little bit before I start trying to sell some contracts. But that's kind of what would happen. So basically for this 541 strike price, we choose it, continue one contract, because this would be my second contract, my second 100 shares of SPY. I'll just do the 0.42. It's going to be net me $42. Good to cancel. I'm going to make about $41.96. Robinhood took about 4 cents away from me. Review the order, submit it. SPY covered call queued. So in the morning when the market opens, someone's going to buy this. They're going to pay me about $42. And then I just wait until the end of the trading day to determine, hey, did my shares get assigned or not? But then I'm getting paid premium upfront. So it's kind of a nice win-win. So there it is, guys. That's how you run a covered call against 100 shares of SPY. I will say this, a lot of people have been asking, can you run dailies on other funds? No. There are specific funds that you can run daily. SPY is one of them, QQQ, IWM, NASDAQ, those type of ETFs can be ran at a daily pace, but usually for an underlying, it's going to be about a week long. And some funds that aren't, that don't have as much trading price, they might only be monthly as well. So it just really depends on what fund is. You can run the strategy. You can do covered calls on any investment you want, but there's just different caveats to each. Some you can do daily. SPY, you can do daily. That's why I chose the SPY. Others are weekly and others are monthly. Some are even more than that. Who knows? But yeah, guys, that's pretty much why I specifically choose SPY. Instead of talking about the cadence of how other options are ran, I'm going to go to one fund that I'm invested in that is a weekly. So that is Oracle. I used to work for Oracle. They gave me a RSC, a restricted stock unit for some of my compensation. So they gave me 200 shares. So let's go over to trade options. And the way that the options work for Oracle is they are weekly. This April 17th, 0 days. This option has been out for a week already. So it was out, April 10th of last week. And then you see next week is April 25. The week after that's May 2nd, then May 9th, May 16th. And they're all about a week apart. So that's what I was saying. And then I think somebody in the community made a message. I think it's SPLG. Yeah, so this fund, they asked about it because I'm assuming the share price is a lot lower. And because the share price is a lot lower, then you can run options against it. But I think this fund only does monthlies. So if we go to trade SPGL options, the expiration for tomorrow is a 0 day, but this has already been out for a month. The next option you can buy is May 16th. So buy, sell. And if we look at this $62.33, you'll make $1.40 for this contract, but that's at the money. SPGL might appreciate past that point. So that's kind of why I recommend choosing something maybe $5 out of the money. So is this, but then if you look at it, because this fund has a $60 share price, it's not going to pay as much premium as something like SPY, where it's like $530. So there's that difference. But this can be done, but you're just not going to be making as much premium. That's why I recommend just biting the bullet, condense some of your investments into one like SPY, and then just run covered calls against. It's the safest bet. All right. Besides that, guys, that's all I have for you today. Hopefully you guys learned something new of me explaining how to run these option strategies. And I hope it's something that you can adopt into your portfolios, because I've invested into high income ETFs for the last 10, 11 months now. And the fact that there's no NAV erosion for the SPY, sure, markets are down and then the fund's down a little bit, but you're locking in premium that isn't pulled out of the share price to pay you back. I think it's great. One downside is you do have to pay tax at ordinary income or short-term capital gains, which is kind of same. So that kind of sucks. But at the end of the day, I'd rather have a higher tax bill and make more money than have, return of capital 100% and then my investment producing a 5% over a year total return. So it's something to think about for sure. But guys, that wraps the video. Hope you're all doing well out there. Hope the portfolios are getting thicker and thicker by the day or by the week or by the month. Matt out, and I will see you at the next video.